If they absolutely have to pay these benefits in the future, then they're gonna charge you more for that because they can't just invest in anything to do it. The amount they would charge would fully reflect the guaranteed nature of the benefit liabilities and the fact that it has to be paid come what may. And the accounting used by public pensions today simply ignores that. In other words, it tells you the pension accounting acts as if they're running a defined contribution plan. Well, if the stock returns go up, stock returns go down, that doesn't make a difference. It makes a huge difference. If stock returns go down, you still have to meet the obligations, and that means that you have to get more money out of the taxpayer to do it. If you look at, I don't know off the top of my head what the annual required contributions are today versus 5 years ago. You mentioned this, we talked earlier. Around the country, they've gone up. And so the idea that we can ignore market risk and ignore the risk of the investments we're taking is simply wrong because we're having to pay more and more and more into these plans as a direct result of the risky investments we're taking. So the risk, I was here a couple weeks ago, they brought me in to debate some pension actuaries at a conference. And the way I characterize the sort of current point of view from the accounting rules is like those old ads. This is like when I was a kid for the Roach Motel, where they say the Roach checks in, but the Roach doesn't check out. They think, it's like the Roach Motel for risk. Risk checks in to the government, but then it never checks out. The government can take risk, but it never comes back on anybody else. And it's just not like that. It's just not like that. When you think of what we have with a pension today is what you call a contingent liability. It's something that may or may not cost us in the future, but those contingent liabilities have value, and people will pay to get out of them. If you look at public policy today, we had contingent liabilities with Fannie Mae and Freddie Mac that did the housing issues. When I was a young staffer in Capitol Hill, they actually they sponsored studies claiming, oh well, the chance of a meltdown for Fannie Mae and Freddie Mac, that's very, very low. Don't worry about it. Just ignore the risk there. We saw what happened with that. Likewise, we have contingent liabilities towards Wall Street because we had to bail them out. Contingent liabilities towards General Motors and the other automakers. Pensions are a very similar situation. The advantage for us is, though, the Wall Street, the Fannie Freddie stuff, the automakers, that's done. There's nothing we can do about that now. With pensions, we can look forward and say, let's get on top of these things. Let's know the risks we're taking. Let's know the investments we're taking on. And let's understand this and take policy steps to avert problems before they happen. It's very easy after a problem has happened to look back and say, oh, well, we all get it now. The key of being in public policy is to get it before the problem happens. And you're getting just enormous resistance from people who simply don't want to hear about how things work out. Now, when you bring these sorts of things up, and I'm sure if you were to bring these things up with people at PERS, there's a number of common objections that come back with. They say all these sort of ivory tower economists, they're spouting this stuff. They don't understand the real world. In the real world, they say, well, government's different from the private sector. They'll admit, okay, if this was a private company, this would make sense. But government's different. The first thing they say is, well, government has long time horizons. So, we don't care what happens year to year. Now, at a practical matter, that's basically wrong anyway, because the majority of a pension's liabilities come due over the next, say, 15 years or so. So they're saying, well, we have long time horizons. We can think about stock returns over a 100-year period. If the majority of your liabilities are due in the next 15 years, you can't guarantee an 8% return over the next 15 years. Nobody can do that. So it's just wrong in that sense. But there's also the idea that over long periods, we can simply ignore the risk from stocks. This is what the actuaries and the folks they work with call this time diversification. I actually brought this up in the study because PERS financed a study done by the actuarial firm Siegel, which is a good firm. But they talk about this time diversification argument. Because government has long time horizons, we can essentially ignore risk. And the thing I pointed out is if you go to your computer and you Google the phrase time diversification, the search results that come up with you along time diversification are like the myth of time diversification, the fallacy of time diversification. Economists say this just basically isn't true. In stocks, it gets a little bit technical to explain. I go through it in the paper. But over a long time period, yes, you might do well in stocks. There's also a lot more things that can go wrong. And if you go to private financial markets, you can purchase what are called put options, which are a financial product that would protect you against the risk of a stock falling short of some given amount. A put option is like an insurance policy against a bad outcome in the stock market. Now, if this time diversification argument were true, if long time horizons make the risk go away, well, then a put option over a longer period would cost less than a put option over just a year or two, because you're diversifying the risk away. It's just not true. If you look at the prices of these insurance policies against stock market risk, the longer the duration, the more expensive they get. So this is one of those things, they trot out this phrase, and they just don't even sort of do the basic due diligence of Google the phrase and see what you're going to find out on this thing. Another objection they'll get is that simply government is different in the sense that government bears the risk, and and so government's a different kind of animal. And the Congressional Budget Office put it this way: they said government doesn't bear risk. What it does is it distributes risk to different stakeholders. As I mentioned before, that can be the taxpayers, that can be bondholders, that can be beneficiaries of government programs. It can be the public employees themselves who might see their contributions rise when things go bad. But the point is, government is a pass-through entity. It's in the same way it used to be thought that corporations bore risk. A corporation is like a person. But back in the 1950s, there's a theorem in corporate finance called Modigliani-Miller, and this won Modigliani the Nobel Prize in economics. But he basically showed, sort of the risks and returns applied to a corporation are passed through to the stockholders, to the bondholders. So you want to view those risks and value those risks the way the stock and bondholders do. The same thing applies to government. So it's really saying, let's value those risks the way the Americans, the people around here who are going to bear them, let's value the risks as they value them. And that's through a market-based element, not through accounting rules that simply ignore them. When you hear this, and it's easy to say, okay, we're presenting an argument, and I hope if you read the paper, you say, oh, this argument makes sense, it's rational. Don't just take my word for, try to read it and see if you get it. But you wonder, well, why do they push back so hard on this? And why are they so resistant to hearing it? Part of it is institutional stuff. If you're the public pensions who have been with an accounting system for so long, or if you're with the Government Accounting Standards Board, which sort of sets these accounting standards, part of it is just pride. You believe in your program, you think your program is doing a good job, you don't want to admit, hey, look, those unfunded liabilities, instead of being 10 billion, they're 40 billion. It's a little bit embarrassing. So there's some professional pride involved in that. But there's another issue as well. And the accounting systems, the accounting rules we use today understate the cost and they understate the value of public sector pension benefits. What people don't realize is that your typical public sector pension plan is a lot more generous than what a typical person is going to get in the private sector. I ran through an example in the plan where I said, let's just take a person and run their wages through what they would get from PERS versus what they could get from a typical 401k plan combined with Social Security, because the public employees here don't participate in Social Security. They both pay the same amount in on average. The total contributions are around the same, but the benefits for somebody under PERS, for a full career employee, are somewhere around 50% higher. And by that standard, look, no, Nevada's not a bad case. You can find examples that are around the country that are a lot worse than that. But essentially, you've got benefits that are a lot more generous than the typical worker with a private sector 401k is going to get. And I think there's an element of that going on as well. That is not simply arguing over accounting rules and this sort of minutia of ivory tower stuff. The accounting rules protect a benefit system that is really a lot more generous than is received by the taxpayers, who are ultimately the ones paying for it. And I think there's an equity issue here, particularly at the state and local level. At the federal level, the vast majority of your taxes are paid by your top 1%, the guys who are being protested on Occupy Wall Street. So in a sense, you could say even if the benefits for federal employees are very generous, it's still being paid by some rich guy, so in a sense it's progressive at least. At the state and local level, it's not like that. You're paying taxes through property taxes, through sales taxes. Those are applied to rich and poor alike. And there is an equity issue, I think, when some guy who's got a 401k, which may have dropped in value, where he's not getting a very generous match from his employer, is paying taxes to finance retirement benefits for public employees who get high benefits, they're guaranteed. And I think there's an equity issue that comes down to gut issues of fairness that I think need to be part of this debate over the overall budget stuff. It's not just some arcane accounting issue. It's not even just a budget issue. It's something that affects real people. It can affect the economy. It can affect the taxes people pay. It can affect the equity in terms of who's receiving benefits and who's paying for them. Given all this, you say, what are we going to do to fix it? And commonly you say, well, let's shift public sector pensions from the sort of defined benefit model they currently have to a defined contribution model. And I agree with that, and I think that's ultimately the way to go. Doing that is not going to erase these unfunded liabilities. The unfunded liabilities are what they are. They're the difference between the guaranteed benefits we've promised and the amount we've set aside to finance them. So shifting to defined contribution plans is not going to make that go away. You've got the hole that you dug for yourself. Shifting to a defined contribution approach, whether it's a pure 401k style plan or if it's something more modest or more in between, like a cash balance plan, is it stops digging the hole. You're not going to eliminate magically all your unfunded liabilities, but you're not going to make them worse, at least. And so a defined contribution approach is much more transparent in the sense that you can't play these accounting tricks with them. If you've got a DC plan where the employer says, okay, at the end of the year or each year we're going to deposit, let's say, $1,000 in each worker's account. You can look in each worker's account and the government either made the contribution or it didn't make the contribution. And if it did, then that's the government's obligation is done. There's no way you can monkey around with that. In addition to this sort of discount rate issue, there's a million different assumptions that are built into public sector pensions that can make them seem more expensive or less expensive. And there is criticism on a variety of areas where, say, a plan's actuaries might tell the fund's board, well, you've got to modify your assumptions regarding mortality, regarding how long people are going to live, because you're assuming they're only going to live this long when in reality they'll live this long. Washington State had this problem, and the pension managers say, sorry, can't do it. That would be too expensive. Well, it'd be too expensive on paper. In reality, you're promising benefits to people who live this long. It doesn't matter what you assume about it.